Hello there, everyone, and welcome to the latest episode of our Market Misbehavior podcast. I'm your host, Dave Keller. I'm the president and chief strategist at Sierra Alpha Research, and I appreciate you so much joining me on the Market Misbehavior podcast, where we strive to connect with top market practitioners, investors, traders, strategists, authors, educators, anyone we can get a mic in front of to talk about market conditions, talk about their process and routines, how they are trying to answer the questions investors are trying to answer here as we navigate these uncertain market environments. Today, I had a fun interview to share with you with Steve Cress. Steve is the head of quantitative strategy at Seeking Alpha. Now, we've talked about Seeking Alpha's products on our YouTube channel a number of times before. This was an opportunity to dig a little deeper into the quant methodology that fuels, in my opinion, one of the real strengths of the Seeking Alpha platform. We talked a lot, this ended up being a conversation about quantitative investing, about the benefits of looking broad, looking for conditions that individual companies can demonstrate by modeling the characteristics of successful companies in previous market cycles. One of the things I thought was really interesting was when Steve was sharing how he, as a fundamental analyst earlier in his career, was able to dig very deep into a small group of 10, 15, 20 names. Now, as a quantitative strategist, he can look across thousands of stocks around a global equity universe and be able to, identify characteristics of leading companies and look for companies that are demonstrating those characteristics going forward. One of the key factors in the Seeking Alpha quant methodology is the momentum factor, which is near and dear to my heart as a technical analyst, because his discussions about momentum investing, about how to define momentum and why strength tends to beget further strength from a quantitative perspective, I would say all of that really provides great ammunition for why charts and technical analysis can be so meaningful, because it's focusing on the information the markets provide back to us in the form of price action. We talked about how, as a quantitative investor, you should adapt your model, how you should think about the relationship between your, alpha model, your quantitative model, and the macro conditions. We talked about the conditions here in early 2025 and how that informs his ability to apply his model to new market conditions. We talked particularly about positioning in Q1, and at the end, he, in no small part, declared the end of the Magnificent Seven dominance, and how we may be bracing for other areas of the market to take on a new leadership role. It was a great conversation, really sort of a mini masterclass on quantitative investing. If you're less familiar with quant models and quant investing, if you've not spent time in the institutional community, you've seen how widespread these models are. Hopefully it's a great introduction to this particular area of the financial markets, which has become a huge, dominant, and very profitable area of the markets for financial institutions. I hope you find this conversation to be illuminating and helpful in understanding quantitative investing. Here's my conversation with Steve Cress, the head of quantitative strategy at Seeking Alpha. So I'm super excited today to sit down with Steve Cress of Seeking Alpha. Steve, I know you're the head of quantitative strategy. I've followed your work and certainly followed the strengths of Seeking Alpha with a lot of the stuff that you've done, but it is so good to sit down with you today on the podcast. Thanks for joining me.
Absolutely. Thank you so much for having me today.
So I'd love for people, I know many people are familiar with Seeking Alpha. I know on our channel, we've spoken about some of the products and their strengths, but a chance to sit down with you and learn a little bit about your process and how you've developed some of these tools, how you use them, I think will be really helpful for people. Let's start off with, where did you come from? How did you get to this point where you're able to start cranking out quant models and powerful tools for individual investors? What's the story? What's the background story to get to this point for us?
Well, that was not the start. I will say I have been basically in Wall Street or the area of finance for over 35 years. And I started as an investment research analyst at what is now Wells Fargo. So I started as a fundamental analyst, but of course, that was a great background for moving into the quant area. The bulk of my career was at Morgan Stanley. I worked there for 13 years. And I ran a prop trading desk in quantitative strategies. I also moved on to Northern Trust Global Investments. And after that, I founded a hedge fund, which was based in quantitative strategies, as well as a fintech company which for lack of a better description was sort of like an auto analyst, not an automobile analyst, but basically an autonomous analyst, where you could
Right.
put in the name of any company or ticker symbol, and it will give you a full 25-page research report that could be updated every day. And
Wow.
it was that platform that was acquired by Seeking Alpha, and I integrated our quantitative technology into the Seeking Alpha platform. So that's a little bit of the story to it.
So it's interesting. So you started, sort of on the fundamental side, but sort of grew into the quantitative space. Sounds like most of your career you've kind of been focused there. What was it? Was it more of the statistical side of analyzing things? Was it more of the mathematical notion of sort of solving the problems of the markets? What kind of drew you to that? Because others are driven to a much more subjective part of the industry. What did it for you?
Yeah, I think as an analyst, I just felt like it wasn't reasonable to be an analyst and just cover like, you know, uh, a dozen to like maybe 20 stocks at a time,
Yeah.
and really be able to state what the valuation of it was, just not looking at a stock and its history or just a small peer group. And that is what led me to sort of bigger data sets, where I would start
Mm,
comparing companies to their entire sector. And it wasn't quite as digital as it is now in the early days. So a lot of it was manual work, but it eventually led to full quantitative screens and the ability to take a look at cash flow statements, income statements, balance sheets, as well as financial metrics and ratios, and being able to compare it for the company that you're looking at to many, many other companies and get a
yeah.
sense of who is strong and who is weak. The other aspect was as a research analyst, maybe quarterly you would update the information on companies. So for all the stocks that I covered, maybe there would be a monthly alert. Certainly there would be a quarterly update on earnings after your initial recommendation when you launched your coverage on stocks. And it didn't seem realistic to me since stocks trade every single day. And really, like with every trade that occurs, you're getting a different valuation level. So if you had a
Mm,
research report that was a month old or 2 months old, that's like going to a newspaper article that's 2 months old and trying to make an investment decision. Uh, as a trader and as somebody who's recommending stocks, I just didn't feel good by sporadically providing updates. It really
yeah.
has to sort of be almost every day. And I think it was sort of that belief that led me to sort of focusing and concentrating on quantitative strategies and implementing that.
It's so interesting. I mean, one of the points you made in there, Steve, which I think was really well said, was just the idea that when you're a fundamental analyst, right, at a brokerage house, for example, you kind of have a very narrow focus, a deep focus on one particular area of the markets. And I know from my time at Fidelity, we would have hundreds of analysts just focusing deeply on one space, and they would be really good at helping you understand Exxon and Chevron and Halliburton, whatever that particular group was. But it would be really hard with that depth of focus to really understand how that group or that stock compared to a US life sciences company or a Japanese bank or some completely different area of the market or different region. And now you've sort of rotated into a practice which allows you to really aggregate, thousands of companies worth of data and just find those consistent things, right?
Yeah, and as an analyst, really the best analysts that are out there, you know, the largest amount of companies they could really cover is about 20 stocks,
Yeah, yeah,
and they'll list the 20 stocks and they'll be comparing those 20 stocks to the other 20 stocks that they cover,
yeah,
looking at, valuation ratios or profitability
yeah,
ratios or growth rates. And you're ignoring like hundreds of other stocks that
yeah.
are in that sector. And, as much as a portfolio manager, may want to hear about a stock that they own over and over again. At the same token, the job of a portfolio manager or an investor is to make money. So you
Yeah.
can't really get fixated to like owning a single stock for years. You have to sort of detach yourself from that and have the ability to really look at what is working. And when we
Mm,
look at what's working, our quantitative strategy, we have 5 core factors. So we're looking for stocks that are collectively strong on growth, value, profitability, analyst EPS revisions, and momentum. Those are the 5 sort of styles that we look at. And again, it's got to be collectively strong for us to recommend the stock. But within each of those styles, there's actually numerous metrics that we look at. So to come up with a company that does have a good value or a good growth, we look at a lot of underlying metrics to get us to that point.
It's interesting. I feel like what you described, Steve, is going from analyzing the veins on a particular leaf on a particular tree versus actually looking at the forest, right? To sort of,
Right.
bring the traditional analogy. And I think that's what a model like you're describing allows you to do, is really look across a broad universe and try to find some things that make sense. Talk to us a little bit about the quant rating, I guess we would call it, the model that I know you developed. When you're, designing a model with these 5 factors, how do you determine, what good momentum is or bad momentum is, what good value or good growth is? How do you actually make that assessment? And then over time, are there ways that you, I guess, update the model or evaluate whether certain conditions are still helpful or not? Talk to us about that model process and how it evolves.
Yeah, so sure. I would say, even though I'm a quant strategist, at the heart of it, I'm still a fundamental analyst. And what we're doing with our quant model, sometimes we refer to it as quantamental, where you take the word fundamental and combine it with quant. It's still fundamental analysis. The only difference is that we have the ability through powerful computers to process a lot of fundamental information. So whereas like one analyst, maybe they can cover 20 companies. As a quant, we can cover thousands of companies and really be able to cipher through the data. So when we're looking at, say, value, we will look at the PE for a company and we'll compare it to the sector median, and we'll be able to determine if it's expensive or if it's inexpensive versus the sector. If we look at the EPS growth rate or the revenue growth rate, we'll be able to look at those metrics for a company and compare it to the sector and determine if it's weak or strong. So by the time we go through like all the metrics where we look for a company to be collectively strong, it is fundamental analysis. So when we're coming forward with a directional recommendation, and that directional recommendation being a buy, hold, or sell, it's based on how the company ranks, the stock ranks on those scores when we're scoring value, growth, profitability, and momentum. And you mentioned momentum. We do look at momentum because historically, really, you can find empirical data going back almost 200 years that shows momentum is actually one of the most predictive factors. So if you were to, by example, take a basket of stocks that were a 52-week high versus a basket of stocks that were at a 52-week low, a lot of people love to go for the stocks that are cheap and beaten up. But the reality is the basket of stocks that are near a 52-week high will have much better performance than the basket of stocks near a 52-week low. So momentum is an important factor. We look at 4 different time periods. We look at a 12-month period, a 9-month period, a 3-month period, and a 1-month period. So we really dissect it down to different levels within a 12-month period. So that's one of the grades. And to sort of give our subscribers an instant characterization of a company as a good value or good growth or good momentum, we actually use academic letter grades. So when you see next to growth an A+, you know that it's far superior versus the rest of that sector. So by example, if we were looking at a technology company, and this particular company, say, Twilio had an A+ for growth, you would know that it's stronger than the rest of the information technology sector. Likewise, if you saw Apple and the value grade for Apple was an F, it's very, very expensive versus the rest of the sector. So we're looking at, as a subscriber, you could literally take a look at a stock page and instantly know if it's a good value, if it's good growth, if it's good profitability compared to the rest of the sector. And that really makes it much easier for people to do their research. And the data behind that is all publicly available. It's either historical data that's been provided by the company to the SEC, where we look at, and our model is forward-looking. It's not just historical looking. We take the historical data, but we also have forward-looking data where we use the consensus of Wall Street analysts. So we'll look at consensus estimates, consensus for revenue, for EPS, for EBITDA. So we're able to balance historical data with forward-looking data, but it's not seeking alpha making the call on the forward data. we're using consensus.
That's a great introduction to what you guys are doing with the Seeking Alpha quant model, Steve. I appreciate it, and I know you would not describe yourself as a technical analyst. I hereby award you an honorary technical analyst designation for your description accurately of the benefits of price momentum. And I would agree. I've tried to build a career off of buying strength and continuing to follow those trends. That's a well-trodden path in the technical analysis community. So we are kindred spirits, I think, at some level. I would say.
And people have a really hard time with that too. It's like, because so many of the recommendations that we have could be close to a 52-week high.
Sure.
But if you're on the platform, I could easily point out, stock can be up 300% in the last 52 weeks. But if you look at the valuation, it could be exactly the same valuation now that it was a year ago. So it means, the company has like a growth rate that's similar and the same value, and it's crushing the rest of the sector on these collective trades, it's still a really good buy. And people sometimes they have a hard time with that concept, but as I said, the empirical data clearly shows it's a very important factor in momentum and strength.
It's so interesting. I mean, we're at a time in market history. I mean, I feel like the macro environment always can be described as confusing, but especially now, it feels like emotional volatility is at an all-time high. We have a new presidential administration. We have a lot of geopolitical risk. We have the Fed in the midst of a rate cut cycle and then maybe pausing. So the macro conditions, I think, are very uncertain. The major averages have kind of stalled out. We're not really making new highs as aggressively. How do you relate what you're seeing with a quant model versus the macro conditions? Do you change the way that you interpret the model, or you would use that? Or is a model like this designed to sort of weather different macro conditions without a lot of tweaking? Like, how do you relate the model to the macro?
Yeah, so actually, periods of uncertainty could be an investor's best friend. And the reason why is, the markets hate uncertainty. Like, if you're in a bull market, the market could normalize that. If you're in a bear market, the market can normalize it. But what the market can't normalize is uncertainty. So you tend to have a great deal of volatility during uncertain periods. And if you took, say, 2023 as an example, there was a great deal of uncertainty, and the markets were up, but it was really basically on 7 stocks that the market was up. Sure. You had the Mag 7 up, I think, on average about 111%. But if you looked at the S&P 500 return, the median return, it was actually negative 16%. So there's just a huge discrepancy, and that was based on a lot of uncertainty that was taking place. And that rolled over into 2024 as well, as in the first half of the year, investors were, they thought inflation would continue to go up and interest rates might continue to go up, or those cuts would never come that the market expected. Eventually that did happen in the second half of the year. So the point that I'm trying to make is, like, during these periods of uncertainty, you can find stocks with excellent valuation and excellent growth rates. And I would definitely say if we run into a period of uncertainty, whether it has to do with the unknown tariffs, will there be tariffs? Will there not be tariffs? Will we have, tax reductions? Will there not be tax reductions? Will we have inflation? Will the Fed be able to take rates down? There's a lot of uncertainty out there. And the best way to use this model is to look at the stocks that have really strong fundamentals. That doesn't necessarily mean that during periods of uncertainty, the stocks are going to be going up. But what it's highlighting is it's clearly pointing out the companies that have good fundamentals because the data is there. So every day we update our model. We see who has strong growth. Every day we see where the current valuation is. So where uncertainty could be your best friend is actually taking advantage during those periods of volatility and identifying the stocks with good fundamentals, because the reward is on the other side of that. And, as I said, I've been in the world of finance for 35 years, and I've been doing quant for a long time. And I will tell you, during periods where there are sharp corrections, the quant stocks normally get hit pretty hard. And the reason is because those are the stocks that had done well. People try to raise cash quickly. They want to take profits. They want to get defensive. So they're going to do it with companies where they've made money. And it sort of makes the correction, a little bit worse. But the great thing about these corrections is they're fairly short cycles. They could last anywhere from 4 weeks to maybe 3 months. Maybe a longer corrective phase could be like a 9-month period. And if you can endure that and stay disciplined and use that uncertainty as your friend, on the other side of it, you're going to have massive returns. So I actually like periods of uncertainty. I always try to keep a little cash on hand. So when we do have those pullbacks, we're going into the third year of a bull market. And typically in the third year of a bull market, I think the probability of a correction is as high as 75%, where you can see a 10 to 20% correction. So like myself, when we had a correction, on I think it was like 2 weeks ago on Monday, we had a little bit of a correction. Some of the stocks that I liked were off 15 to 30%. And I was just in there buying. And it was amazing how quickly they came down, but it was even more amazing how quickly they came back. And, when we had the tariffs come out this Monday, I guess on the Saturday they came out, the markets, pulled back sharply in the morning. It was just like a great buying opportunity because a lot of the stocks that had the quant strong buys on it pulled back significantly. And then by the afternoon, like I was making money. And that's normally not that quick. Usually it takes a lot longer. And if we do have a correction that is 10 to 20%, it's just something to take advantage of. And I will highlight too, we have had periods like this. Usually after the year after a presidential election, there is an increased chance of a correction, but typically the markets finish higher that 1 year out. So you want to take advantage of that. And typically also in the year following Federal Reserve interest rate decreases, the market tends to do better as well. So there's a lot of weight to support, the market having a bit of a pullback, but by the end of the year, the market should be in a better place. So I'd say try to make uncertainty your friend. The model is the model. Most quant models, that focus on companies with strong fundamentals, when you do have corrective phases that are driven by sentiment, there's no way around it. They're going to have pullbacks, but the people who can stay disciplined and brave will just search for those companies that have great fundamentals and buy them.
See, there's so many really good points, little nuggets of investment wisdom in what you just described. And two things I always tell people about, 10 to 20% correction, even a little more. Number one, they happen. And number two, if you look back in market history, the markets have recovered 100% of every one of those, right? We've ended up recovering them at some point. Sometimes it takes a little longer than others, but we've always made it back, right? And those corrections often give you the opportunity to buy great companies at a deep discount. So I 100% agree with your assessment there. Now, one layer that I know you guys have added more recently is what's called alpha picks, which I believe is you're actually identifying some names that are scoring well. Can you talk a little bit about that particular aspect of it, how those are differentiated from other names in the model?
Yeah, absolutely. So what we do with the alpha picks, I'll put it in the context that Seeking Alpha has a great platform, and we provide research on thousands and thousands of stocks. I think the quant system covers almost 5,000 stocks. Wow. And on any given day, there could be anywhere from 350 to 400 strong buys. So it still requires a fair amount of research. And about 2.5 years ago, we had a lot of people say, can you just give us your top recommendations? The quant system, it works well, but they just wanted their lives to be a little bit easier. And, a lot of these individuals, they were intelligent, sophisticated investors. Others just did not have time. But it seemed like there was critical mass that people just wanted to get the best ideas. So I created a product called Alpha Picks about 2.5 years ago. And what we do with Alpha Picks is twice a month, the trading day closest to the 1st and the 15th, we send out our top strong buy. So it's meant for people who are long-term investors who are seeking capital appreciation. There's not a lot of turnover in it. We build up the portfolio. So as I said, each month you get 2 new ideas. And when stocks become a sell, we notify people immediately. We send out an email and we put it up on the Alpha Picks platform so they know to sell a stock. And in fact, we actually keep the stocks that change to hold in the portfolio for 180 days, because I often tell people hold means hold. It doesn't mean sell. And as you know, stocks trade thousands of times a day. Sometimes the valuation frameworks can go back and forth into territory, that triggers a default to a hold, back to a buy. So you don't want to necessarily get out of a stock when its valuation framework could be on the fence like that. So it really pays to stay in the stock for a while when it's a hold. So the performance on Alpha Picks has been fantastic. We started, as I mentioned, in about 2.5 years ago. It was July of 2022, and since inception, the portfolio is up 185% versus the S&P for the same period, which is up 61%. Over the last for year to date, I will tell you the portfolio is up 7.5% versus the S&P up 3%. Over the last year, the portfolio is up 39.5% versus the S&P up 22%. So you can take any different time period, and the recommendations have really performed quite well. Even over the last 4 weeks, we're up about 3.5% compared to the S&P up 2%. So consistently throughout different time periods, it's performed well. And it's really good if you don't have time to do the research yourself, or you're just looking for exceptional ideas. We just sent you 2 a month.
No, that's super helpful, Steve, and I appreciate what you've done with that, because I know, I have a lot of experience working with quantitative models and with quantitative money managers, and I would say as a technical analyst, you're really trying to identify specific tactical opportunities out of a subset of ideas. And when a quant model is spitting out hundreds of ideas at any particular time, right, trying to focus your attention on the real actionable ideas, it's a time very well spent, of course. So I have to ask you this to finish off, Steve. Given the macro environment as you described, and you hit on a number of the things we're all sort of trying to get our heads around, as you're using the model, as you're trying to assess opportunities, where do you see opportunities here early February of 2025?
I'll tell you, I believe we're going to see a fairly decent rotation out of the Mag 7 stocks. Yeah. And those are the stocks that led in 2023 and 2024. And one of the reasons, just on fundamentals, most of the Mag 7, actually all of the Mag 7 stocks have a forward CAGR earnings growth rate that is lower than the year-over-year growth rate. And as you saw with Google the other day with its earnings, and a number of other mega tech stocks, I think as they report earnings that people begin to see the growth is slowing down a little bit, it's not really going to justify the valuations that those stocks are up. And really, those 7 stocks and their ultra high valuations, it's sort of disrupting the PE for the overall market. Sure. If you strip out those stocks and you just look at like the S&P 493, the PE is actually a lot lower when you take that out. So it's sort of an outlier situation. And I think, just really off of probably sheer exhaustion of people investing in those stocks and the realization that growth is going to be lower, it's setting the stage for a rotation and really more of a normalized market period. I don't think we're going to see interest rates going up this year. I don't think inflation is going to be going up this year. It might be a little sticky, but it should be going up. Certainly, the outlook for the Fed is rates will either stay flat where they are, or maybe we'll have 1 to 2 rates cuts downward. So I really think that serves up an excellent situation to be looking at smaller cap stocks, mid cap stocks, or just stocks that really have good fundamentals again, where, over the last 2 years, the market has had so much uncertainty and it's been driven by sentiment, and that sentiment has really taken sort of the face of a defensive investor. So they may have been going in the Mag 7 stocks because of AI, but more likely people and investors were going into the Mag 7 stocks because of uncertainty. And they're the 7 largest stocks. They're the most profitable companies. They have the most amount of cash. So as an investor, if you're scared, you want to be in those type of companies. So, it used to be when people would get defensive, they would go into utilities or consumer staples. But sort of the new defensive look now is really the Mag 7 stocks. And now, these companies, again, they're going to be facing growth rates that are lower. And meanwhile, their spending is going through the roof with how much they're pouring into AI. It just, I think, really sets up nicely for a rotation into many other stocks in many different sectors.
Maybe the glory days of the Mag 7 dominance is over here. We'll see. We'll see if that's proven true, Steve. But I appreciate you suggesting that. And I wouldn't disagree. I mean, I think from any sort of thorough analysis of the valuations, the growth rates, but also the technical configurations. I mean, these are names that have been dominating and have arguably gotten way over their skis in terms of their upside trajectory. We'll see. We'll see where those rotations may end up. Steve, this was a real pleasure. Good to get to know you a little bit. Great to hear a little bit more about how you've developed some of these quant models and how you're applying them in the current market environment. Thanks for coming on today. I hope we can have you later on in the year to sort of check in and see where the opportunities may lie.
Yeah, thank you for organizing. It was a pleasure to be here. Thank you.
It was so cool. I hope you enjoyed that conversation with Steve Cress of Seeking Alpha. Toward the end, we were talking about the Alpha Picks product, which is a newer product that they created. Basically, Steve and his team curating the names that are graded favorably by the quantitative model and handpicking a couple every month to share with subscribers. And that sort of approach of taking a broad quantitative model, looking for strong companies, demonstrating favorable characteristics, but then curating that list and identifying particular names that seem actionable based on their unique circumstances is a tried and true approach. That's how we used quantitative models in my previous life as on the institutional investing side. We would run a number of alpha models, but then identify some of the stocks rated favorably by the models that also scored well based on fundamental characteristics, based on technical characteristics, where analysts making a more subjective approach would find names out of those models that tended to score pretty well. I thought some of his comments just about how to construct a model, the idea of multi-factor weightings, how to weight a list of stocks based on momentum or valuation or earnings growth or quality, and thinking about how to apply those models in changing macro conditions, I thought was really well said. I've used the quant rating from Seeking Alpha before, and have enjoyed leveraging their products. But it was a real joy to be able to ask Steve some specific questions about how he designed it, how he uses the model in his own process, and how he sees that model adapting to evolving macro conditions. Really great, and I'd encourage you, if you want to learn more about the tools and techniques that Steve was talking about, you can go to marketmisbehavior.com/seeking alpha and learn more about their products. You can also go to marketmisbehavior.com/alpha picks. Here in mid-February, they're actually running a special on their Alpha Picks product, so I'd encourage you to check it out, learn more about the products and techniques that Steve was talking about today. Also, if you want to learn more about that technical analysis side of the equation, some of those things that are fed into models like Steve was discussing, using momentum and focusing on trends and relative strength, or what we call price momentum or momentum investing. If you want to learn more about some of the tools and techniques that can help you optimize momentum investing and identify good opportunities for yourself, our Market Misbehavior Premium memberships are a great way to learn more about the technical analysis toolkit, about all the behavioral biases that tend to proliferate in your process, and how you can use technical analysis to minimize their negative impact. 3 great benefits to the premium membership. Number 1, it is the virtual courses. So you have a bunch of courses on demand. We'll teach you all about technical indicators, about routines, and how to evaluate market trends using some of the tools and techniques that we talk about, and also some of the behavioral biases you probably find very common in your own process, and how we can minimize their impact. We also have members-only reports like our weekly flight plan and our monthly chart review, and access to a members-only community where you can ask questions of me, some of my other premium members, a community of like-minded investors trying to navigate these markets together. You don't have to do it alone. Come join the community, and we can do it together. For more information, go to marketmisbehavior.com/premium, and don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That's it for today. For Market Misbehavior, I'm Dave Keller. Thanks so much for joining me here on today's webcast. Wish you guys the best on your ongoing investing journey. And remember, it's always a good time to own good charts.